You're listening to The Moose and the Loose, your 10 minutes action-packed financial podcast with your host, Mikey Hu. Hey, what's up, Market Moose? This is Mike from The Moose on the Loose. Happy Wednesday. I told you yesterday already. Today I'm going to talk about a very frustrating company to hold in my portfolio. I've been holding it for a few years now and currently showing a price return, so excluding the dividend. So price return minus 25%, 25.84 as of recording on July 1st. So pretty accurate, right? So down 25%, maybe with the dividend, I'm like, I don't know, like down 20 something, like maybe 19% or 18%, still not like double digit. Not cool at all, and very tough to keep up with that love, right? Because when you're having a company in your portfolio showing negative results, while the rest of my portfolio is doing well, the rest of the market is doing well, so you start to think, well, am I wrong here? Like, is the market knowing something that I just ignore and I keep on investing in the bad business? So let's take a look. Granite REIT, grt.un.to trades on the TSX, trade also in US dollar, grp.u, if I remember correctly. Business model, quite simple, industrial REIT. About a little bit more than 10 years ago, it was a spin-off of Magna International Properties. So at first it was like almost 100% revenue coming from Magna International. Today, we are at 27% of revenue coming from Magna International. So still big exposure to Magna, and then it quickly drops to Amazon at 4.1%. So, and after that, you have like Mars Pet Care at 2.7, True Value at 2.2, and Adessa, which is the fifth largest tenant by percentage of rent, which is at 1.8%. So nothing to worry about after Magna International. Well diversified in terms of tenant diversification. They offer industrial properties, mostly warehouses and distribution centers. So for consumers companies, for online e-commerce companies as well, 61% of their gross lease area is in the US. So 61 in the US, 12% in Austria, 11% in Canada, 7% in Germany, and then 8.5% in Netherlands. So literally good diversification, but still big concentration in the United States, big concentration in Magna International. But the REIT still shows an occupancy rate of like 95%, which is very solid. The average lease term is somewhere around like 5-6 years. So very stable. Escalator rents, the escalator contracts. So they are able to do well on this, growing their revenue. So the company is actually doing pretty well when you look at the numbers. The funds from operation per unit is growing. The dividend is growing as well. So those are like super important metrics in my mind. Of course, you don't expect to have like a super high growth rate. We're talking about a dividend growth rate of like 3% a year. But with an AFFO payout ratio around like 70%, down to 67 for the first quarter of 2024. You have a pretty solid business model. There are like many REITs actually don't increase their distribution every year. Granite has been doing that for a while now. On top of those steady increases that matches or slightly beat the inflation, it offers a pretty decent yield right now at 4.85%. Pays a distribution monthly, shows like more than 10 years of dividend growth rate. The payout ratio is good. The FFO per unit is growing. So what is the problem here, right? So when I look at all the numbers, I'm having a hard time. I do see risks though, of course. The first one is the dependence on Magna International, 27% of your revenue. That could kill your business model entirely if Magna International runs into major problems. So far, it's not the case. And for Magna International, the average lease term is 7.4 years. So it would not be cut out and canceled like all of a sudden it would be gradual over those years, and Granite can enjoy a lot of payments from Magna International. And mind you, Magna is like not doing incredibly well, but they're pretty far away from like shutting down their business. So that's not necessarily the biggest problem. Another problem that the market sees, and I tend to agree, but so far Granite has been able to manage it, is the interest charges. So all REITs, they leverage their properties, they remortgage them. So of course, they have to deal with debt maturities, and now they renew their debt at a higher interest rate. So interest charges keeps on growing quarter after quarter. It hurts FFO growth, so funds from operation growth, but not enough for Granite to slow down, because they do have a huge pipelines of new opportunities, and with a very high occupancy rate, they know that the demand for industrial properties remains strong even in this economy. So why the stock is down 25% over like the past 2-3 years? If I look at the total return over the past 3 years, we're at -7%, including the dividend. So nothing to make me smile here. And as a comparison, the TSX 60 did 18%. So 18% or -7. Pretty big gap, right? So not encouraging to go forward. Other risk besides that, well, at one point, probably a discrepancy between the offer and the demand. So having like too many properties, industrial properties, that you need to still maintain them. So high cost of maintenance if you do not have tenants. So that could be a problem. Right now, I don't see it happening. Maybe the market is just worried about a major economic slowdown, because if we are going into a recession, that could also be hurting Granite. But it seems to me that overall, what we have here is a lot of like negative sentiment around stories that are not backed by facts right now, because Granite is able to grow their FFO per unit even with higher interest rate. They show a high occupancy rate and more pipelines for new properties development, even though we may go into a recession. And they are able to grow their distribution to match or beat inflation with an average of like 3.1% every year, with a very solid payout ratio, like 67 right now, but 70% overall AFFO payout ratio over a long period of time is pretty sustainable for any type of REIT. So am I holding it for a long time still? Yes, because my investment thesis about this growth still is good. It is still backed by numbers. So I do have my own narrative that is backed by numbers right now. So I don't really care about what the market thinks, as long as the numbers are there to back me up. So I don't know how long it's going to happen, but in the meantime, I'm super happy with Granite in my portfolio for what it represents. And I often say to investors, it is important, especially for short term, like for 1, 2, 3 years, if you just give a value to your holding based on your stock returns, you're making a big mistakes. Why? Because the market can decide that they love Granite tomorrow morning, and then the stock price could go up like for the next 6 months. Or it could just continue to fail. But if the numbers are there and the fundamentals, if the business is actually healthy and growing, I have no problem holding this one. So as long as the dividend increase, as long as the payout ratio is under control, and as long as the company keeps on growing their revenue, growing their FFO, and on top of that showing strong occupancy rate, I don't see any reason for selling. So I try to not look too much too often on the -25 that it shows in my brokerage account. And besides that, I'm very happy. So that's another trick. If you don't open your brokerage account every single day, it will not be a reminder that some of your stocks are losers, right? So rather review your portfolio quarterly. Let the business do what they do best, which is create value for shareholders over the long term. Patience is your friend. It's your best ally in this investment journey, because you're not investing for the next 3 years. You're likely investing for the next 30, maybe 50 years. So keep that in mind. And we're going to talk again tomorrow about the only investable banks right now in Canada, because the choice is quite limited when you consider those risks. So don't forget to give me don't forget to rate this podcast if you have not done it yet. Go on Spotify or on Apple Podcasts and give me a 5-star review if you enjoy this episode. And we're going to talk again tomorrow about the only investable banks right now. Stay tuned and stay invested.
Hey, welcome to the disclaimer. If you're listening to The Moose and the Loose, you cannot really expect me to give you buy or sell recommendation or financial advice, right? You're here for fun, you're here for information and some entertainment. But I am not your financial advisor, I am not your broker, so therefore I'm not liable if you're losing money after listening to the podcast. If you're looking for some advice, go see a professional. If not, you can enjoy this show and do your due diligence after it.